You're scrolling through your brokerage app. A stock catches your eye. Maybe it's been going up forever. Maybe a friend won't stop mentioning it. Maybe every YouTuber suddenly has a video about it. And you think, should I finally buy this? Here's the thing nobody tells you. The question you're asking is the wrong question. Is it a good company? Doesn't matter. Is the chart going up? Doesn't matter. What's the PE? Barely matters. There's only one number that matters, and it's the one you've almost certainly never run. It's the growth rate the stock's current price is quietly demanding from the company underneath it. Not the growth analysts predict, not the growth the company hopes for. The growth the price itself, right now, on your screen, requires the company to deliver. If the company hits it, you make money. If it doesn't, you don't. In the next few minutes, I'll show you exactly how to find that number on any stock, and what we discover when we run it on 4 names you'll recognize is going to surprise you. Let's slow down for a second and make sure we're talking about the same thing. When you look at a stock price on your phone, say it's $120 a share, your brain treats that as a fact. The price is the price. But that number isn't really a fact. It's a contract, a specific, measurable contract between the company and everyone who owns the stock. Here's the contract. The price says, this company is going to grow by some amount over some period of time and produce enough cash that owning a piece of it today is worth the trouble compared to just parking your money somewhere boring and safe. Every share price on every screen, everywhere in the world, is silently making that statement. It's just that nobody ever translates it for you. The number we're after is the translation. Take the price. Compare it to the actual business underneath. How much revenue the company currently produces, how mature its industry is, what a reasonable end state looks like, and work out what growth rate would have to be true every single year for the price to make sense. Not make you rich sense, just match what doing nothing would have earned you. Sense buying a plain index fund instead. That's the number. The growth required to justify the price, just to break even against the lazy default. We're going to call it the implied growth rate, because that's what it is, the growth the price implies, whether the company has agreed to it or not. Why does this matter? Because most of the questions you've been taught to ask about a stock, is it cheap, is it growing, is it loved, answer a question that's already been answered for you by the price. The price has already declared what it expects. Your only real job before buying is to check whether that expectation is realistic. And almost nobody does. Now, you might be thinking, wait, isn't this what the PE ratio is supposed to tell me? Isn't that the whole point of PE? Cheap stock, good. Expensive stock, bad. Pull up the brokerage app, look at the number, done. I want to be careful here because PE isn't useless. It's just enormously oversold. Let me show you what it actually does and what it doesn't. The price-to-earnings ratio takes today's price and divides it by last year's earnings. So a PE of 20 means investors are paying $20 for every $1 of profit the company just made. Useful as a quick gut check, useless as a decision. Here's why. PE is a snapshot. The implied growth rate is a contract. PE tells you the wrapper, what people are paying today, relative to what the company already did. The implied growth rate tells you what the company has to do next. Imagine 2 companies. Both have a PE of 40, which on any retail finance site would label them both expensive. Company A is a mature business in a slow industry, with margins already near their peak. Company B is a younger business with margins still expanding and a market many times bigger than what it currently serves. Both have the same PE. The price is asking wildly different things of each. Company A, at 40 times earnings, is asking for a miracle. Company B, at the same PE, might be asking for something perfectly reasonable. This is the trap PE sets. It treats every company as if it lives in the same future. It doesn't. The same multiple can be cheap on one stock and absurd on another, depending on where the business is actually going and what's possible for it from here. And there's a worse problem. Companies that are temporarily losing money have no real PE at all. The denominator collapses. So entire classes of investments, early growth companies, cyclical businesses in a down year, Anything in transition, get a PE that's either blank or so distorted it tells you nothing, which is exactly when you'd want a real tool the most. The implied growth rate doesn't care. It works on any company that has revenue, which is every company on the public market. It doesn't depend on the messiest year of earnings. It looks at what the price is asking for, not at what last year happened to produce. That's why pros use it. And that's the number we're going to learn how to run. Okay, let's actually do this. And I'll warn you up front, this is the section where some people get bored and click away. Stay with me because once you see how plain the arithmetic is, you can never unsee it, and you'll never look at a stock price the same way again. Here are the pieces you need. There are exactly 5 of them. 1. The company's market capitalization today. That's just the price per share times the number of shares, the total price tag on the entire company. Every finance app shows it. 2. The company's revenue over the last 12 months, not profit. Revenue, the top line, the total sales. Also easy to find. 3. A target return. This is what you want from your investment per year for taking the risk. We're going to use 10% because that's roughly what a plain index fund returns over long periods. 10% a year is the boring baseline. Anything less than that, and you've made yourself worse off than doing nothing. 4. A time horizon. We're going to use 10 years. Long enough that the future has a chance to play out. Short enough that we're not pretending to predict things 60 years from now. 5. An end state assumption. This is the only judgment call in the whole process, and we're going to be deliberately generous with it. When the company is a mature business 10 years from now, what multiple of its revenue would the market reasonably pay for it? For a great tech company, maybe 8 times its sales. For a mature retailer, closer to 1.5. For a pharmaceutical giant, around 5. These aren't guesses pulled from nowhere. They're the multiples mature businesses in those industries actually trade at right now. Those 5 inputs are everything you need. Here's the math in plain language. The market cap has to grow at 10% a year for 10 years to justify the investment. That means the market cap in 10 years has to be about 2.5 times what it is today. Now divide that future market cap by the end state multiple. That gives you the revenue the company has to have 10 years from now. Then ask what annual growth rate, starting from today's revenue, gets the company there. That growth rate is the number. The implied growth rate, the price's silent demand on the future. Let me show you how plain this is with an example. Suppose a company is worth $100 billion today with $20 billion in revenue, and we expect it to mature at 5 times sales. 100 billion times 2.5 is 250 billion, the future market cap required. 250 billion divided by 5 is 50 billion, the future revenue required. Going from 20 billion to 50 billion over 10 years works out to about 9.5% a year. That's the number. The price is silently demanding 9.5% revenue growth every year for a decade. If you believe the company will deliver it, you proceed. If you don't, you walk. That's the entire framework. No charts, no story, no countdown timer. Just 5 numbers and a clear question. Now let's run it on 4 stocks you know. Start with the most famous stock on Earth right now, NVIDIA. About $5 trillion in market value, riding the wave of artificial intelligence harder than any company in history. Its revenue over the last 12 months is around $253 billion. Itself an extraordinary figure for a company that, not many years ago, was mostly known for gaming graphics cards. Run the number. To justify the current price, with a generous mature tech exit multiple of 8 times sales, NVIDIA needs to grow its revenue by about 20% a year, every year, for 10 straight years. Now here's where this gets interesting, because NVIDIA is currently growing far faster than 20%. Its most recent quarter showed revenue up 85% year over year. So you might think, well, 20% should be easy for a company already running at 85. That's where the trap is. The question isn't whether NVIDIA can grow 20% next year. It's whether NVIDIA can sustain 20% plus growth for 10 consecutive years, from a base that's already $250 billion. To get there, NVIDIA's revenue would need to reach roughly $1.6 trillion in 10 years. Roughly 4 times the current revenue of Apple, which is the world's most successful consumer technology company. No company at this scale has ever sustained that pace for a full decade. The price isn't asking NVIDIA to be great.